Imagine your home loan EMI jumps by thousands of rupees a month. You didn't buy a bigger house, the bank didn't change its fees, you didn't lose your job. So, what happened? Somewhere a number in the bond market moved, and it quietly rewrote your monthly budget without ever sending you an invoice. Most people think the stock market is the center of the financial universe, but there's a silent $145 trillion machine that actually dictates your home loan rate, your car loan, and your retirement portfolio, the global bond market. When bond yields move even a fraction of a percent, borrowing costs for regular people move with them. In India, this is exactly why your home loan EMI changes every time the RBI adjusts rates. That's the bond market's fingerprints on your life, whether you've ever bought a single bond or not. By the end of this video, you'll understand exactly how this invisible machinery works and how you can actually use it, not just be affected by it. Here's a number that surprises people. The bond market is bigger than the stock market and has been for a long time. That matters for your own portfolio too. If you've invested in equity, mutual funds, even global stocks, but your bond allocation is zero, you're not actually diversified. You're standing on one side of the boat, and one market crash takes your entire portfolio down. In India, the bond market is worth roughly 240 lakh crore rupees, about $2.8 trillion. Of that, corporate bonds make up only around 22%, roughly 54 lakh crore rupees. Still a relatively small developing slice. CRISIL estimates the corporate bond market could roughly double by 2030. Why does anyone issue a bond at all? Governments spend more through roads, welfare schemes, and salaries than they collect in tax revenue. That gap has to be funded from somewhere, and that somewhere is the bond market. Governments can't sell shares of themselves, so they fund their entire deficit, infrastructure, and public spending through bonds. Here's a real number to make that concrete. In the 2025 to 26 union budget, the government projected total spending of roughly 50.65 lakh crore rupees against total receipts of about 34.96 lakh crore rupees, a gap of nearly 15 lakh crore rupees. Most of that gap gets bridged through government bonds, bought by banks, insurance companies, mutual funds, and retail investors like you. Companies issue bonds too, for expansion or to refinance old debt. So why not just take a bank loan instead? Three reasons. Bonds let a company raise money at a scale a single bank may not want to lend alone. A company with a strong credit rating can often raise funds at a lower interest rate through bonds than through a bank loan. And bank loans come with strict operational restrictions, while bonds are far more flexible. A real example. In January 2022, Reliance Industries issued bonds across three tenures, maturing in 2032, 2052, and 2062, paying 2.875%, 3.625%, and 3.750% respectively. These were aimed at US markets where those rates are considered attractive for a developed economy investor. Bonds are essentially the plumbing of the entire economy. Without them, governments can't build roads and companies can't grow at scale. And investors get a place to lend money for predictable income in return. In simple terms, a bond is a written IOU. When you buy a bond, you're lending money to a company or government. You don't become an owner the way you do with a stock. You become a lender. In exchange, they promise you fixed interest, paid regularly, and your full principal back on a set date. Four terms to remember. Face value, the amount you get back at maturity. A 1000 rupee bond means 1000 rupees back at maturity. Coupon rate, the regular interest. A 1000 rupee bond with a 7% coupon pays 70 rupees a year, like clockwork. Maturity, the expiry date when the principal is returned. Could be a 3-year, 5-year, or 10-year bond. Yield to maturity, YTM, the actual return you earn if you buy at today's market price and hold to maturity, factoring in that price, not just the coupon. Here's where it gets interesting. A 1000 rupee bond at 7% pays 70 rupees a year. But bonds come with a second number too, yield to maturity or YTM. Two return metrics on the same bond. Why? The coupon is fixed, always calculated on face value. 1000 rupees at 7% is always 70 rupees, no matter what price you actually paid for the bond. YTM is the actual return you get by buying at today's price and holding to maturity. It factors in your purchase price, not just the coupon. If a bond is issued at its face value, 1000 rupees for a 1000 rupee bond, coupon and YTM are the same. But say that same bond is available to you at a discount at 940 rupees. Now you're earning 70 rupees a year in interest and getting the full 1000 rupees back at maturity, a 60 rupee capital gain on top. That's a double win. Coupon plus price gain. So in this case, your YTM will be higher than the coupon, above 7%, because YTM captures both. One catch: this double win is only locked in if you hold the bond to maturity. Sell it early, and what you get depends on that day's market price, which isn't guaranteed. Here's the mechanic that explains almost every bond price move you'll ever see. Bond prices and interest rates move in opposite directions. Say a company issues a bond with a 1000 rupee face value and an 8% coupon at a time when bank FDs are paying 7%. The bond looks attractive, better than the FD. But now say FD rates climb to 9%. Suddenly, 1000 rupees in an FD earns 90 rupees a year, while the bond is still locked at 80 rupees. Nobody wants the bond at its old price anymore, so its price has to fall to stay competitive. If it drops to around 850 rupees, the same 80 rupee coupon now works out to an effective yield of about 9.4%, back in line with what the market demands. This isn't just theory. On May 4th, 2022, the RBI announced a surprise 0.4% hike to the rate at which it lends to banks. The moment that notification came out, Indian government 10-year bond yields jumped sharply the same day. Real proof this isn't abstract. The takeaway: bond prices aren't static once issued, they move with interest rate expectations. Every Indian investor asks this: why bother with bonds when I have an FD which feels safer? Bonds are tradable, bought and sold in a live market, and that one difference opens up several advantages. 1. Bonds carry the possibility of higher returns, especially corporate bonds. 2. If interest rates fall, your bond's price rises, meaning you're getting capital appreciation too, something an FD simply doesn't offer. 3. You can lock in a good rate for decades, not just a few years at a time. That's why a smart investor doesn't park all their money in one product. They diversify across equity, mutual funds, bonds, real estate, and global investing. Bonds play the role of stability and income in a portfolio. India's bond market has real variety, so let's match them to your goal. Want maximum safety and government backing? Go for GSECs or government securities. Want to park cash short term and beat your savings account while doing it? Treasury bills or T bills, 91 or 182 or 364 days. Issued at a discount, you pay 98,000 rupees and receive 1 lakh rupees at maturity. That gap is your return. Here's why this matters. A typical savings account pays around 2.5 to 3%, while short term T bills often yield meaningfully more, sometimes into the 6% range, depending on current rates, for virtually the same safety, since both are about as risk free as it gets in India. Parking idle cash in a savings account instead of a T-bill is quietly leaving real money on the table for zero extra safety. Want a higher guaranteed rate with zero credit risk and don't mind locking it up? RBI floating rate savings bonds, sovereign bonds issued directly by the RBI on behalf of the Government of India with a full sovereign guarantee and no upper investment limit, unlike a bank FD which is only insured up to 5 lakh rupees. The rate floats, pegged to the National Savings Certificate rate, plus a fixed spread, and has recently been running close to 8%. The trade off: a 7-year lock in, only senior citizens can exit early with a minor penalty, and interest is paid out semi annually as simple interest with no built in compounding. Minimum entry is just 1000 rupees, so it's accessible even for small amounts. Want slightly higher yield but still trust government backing? SDLs or state development loans, states raising money for their own projects. Want to invest in the public sector? PSU bonds, government backed companies across power, railways, infrastructure, finance. A strong PSU is considered relatively stable. Want the highest potential return? Corporate bonds issued by private companies. A rated large companies are relatively safer. Lower rated companies offer higher yield with correspondingly higher default risk. Before investing in any bond, evaluating its rating is essential. Bonds rated AAA down to BBB are considered investment grade. Anything below that is high yield or junk territory. The lower the rating, the higher the yield, because the market compensates you with extra interest for extra risk. In India, rating agencies like CRISIL, ICRA, CARE, and India Ratings assess an issuer's ability and willingness to repay. But ratings aren't permanent, and here's the most important point. A rating is an opinion, not a guarantee. A AAA rated company can get downgraded if its financials weaken, sometimes faster than investors expect. Judge the financial strength yourself too, not just the letter grade. We're going to go much deeper on exactly this default risk, real Indian examples, and the full risk picture in the next video. So, who are bonds actually for? Conservative investors who want stability and predictable income, retirees or income seekers who want a fixed income stream in place of a salary, diversifiers, anyone already holding equity and mutual funds who wants a counterweight asset class, and tax conscious investors for whom tax free bonds genuinely matter. If you're eligible, submitting Form 15G or 15H can stop TDS from being deducted at source. But one thing needs to be crystal clear: bonds are not risk free. So match the bond type to your goal and risk appetite. Quick recap: bonds are a written loan, not ownership. Face value, coupon, maturity, and YTM are the four terms to know. YTM beats coupon when you buy at a discount, but only if you hold to maturity. Bonds beat a plain FD on tradability and potential price appreciation. And in India, you've got a full spectrum from GSECs to corporate bonds to match your safety versus yield preference. We only scratched the surface on risk today. Next video, we go deep on exactly what can go wrong with a bond, real examples, and how to protect yourself. Subscribe so you don't miss it.